Welcome to episode 29 of Contrarian Corner. I'm Ben Kelleran. Today we have a very special guest to talk to us about 6%, 10 years, inflation, Project Zimbabwe, and everything else in financial markets. But he has a very interesting Substack called Your Weekend Reading and has some very interesting views and some very contrarian takes on the market. So, Erik, thanks for coming on.
Ben, thanks. Good to be here.
Yeah, so I figured if you could give us a quick primer on your background, just so people kind of have a feel for what your experience is, so they know kind of where you're coming from. I think that'd be a good place to start before we jump right into bonds and rates and inflation.
Yes. Well, Ben, you're in Idaho. Sorry, you're in Portland, and I'm originally from Montana, but worked for quite a while in San Francisco. Started out as an analyst at a mutual fund company, and my specialty was financial services, global financial services, so banks, asset managers, exchanges, et cetera. Did that for a long time. Was a portfolio manager at a hedge fund running a global financials book, long short. For through the financial crisis and everything, so I run the book through a lot of volatility. But eventually went on, had a job change, and ended up running an Africa fund for 6 years, which eventually closed down just for mostly lack of interest and people, and Africa underperforming for so long it wasn't viable. But that was an interesting experience, and why often I write about inflationary dynamics I learned in Africa and how markets work in periods of higher inflation, which I think is counterintuitive to a lot of people. And then since then, I've been writing a Substack called YWR, Your Weekend Reading.
Yeah, I think it's interesting to see, because I think at some point between 2020 and 2022, I think we kind of had a regime shift, and there's a lot of things that even people that have been in the market for decades haven't seen, and there's been a lot of disinflationary forces, and I think that trend has changed, and we'll see where it goes from here. But I think inflation's gonna come back and be a sticky issue. So I think that'd be a good way to transition into your view on bonds and inflation and rates and some of the stuff there, because I think everyone's kind of seeing, oh, there's gonna be more rate cuts, and I've seen some interesting projections for where we're going as far as Fed funds. But I think it'd be interesting to dive into your thoughts on bonds and where how inflation could impact that moving forward.
Yeah, let's just start with what you said right at the beginning. And it's a tough one, and there's no definitive answer, but I'm in your camp that we've had a regime change since COVID. Like, we'll look back, and that was a defining shift in where we came out of this deflationary dynamic. And I think I think that's the longer term shift. It will affect inflation rates and bonds. And I think a lot of things will change. I kind of call it a phase transition. And this is where it's kind of like when water goes to ice, or air goes to or water goes to a gas. It's like the whole economy acts differently. And I think that's why, and that's something the Fed a lot of academics still kind of think that we're back still in the deflationary dynamic, and they don't get that things are acting differently now. So, but again, I have masters in economics, so I know that this topic is extremely difficult, and economists have a huge history of getting this wrong. It's very hard to predict. So I think you and I are it's more of a gut feel, and at this point, because it's really impossible to define whether we're in a higher inflation environment or not in going forward. But I think we are. And but I am also careful. I'm also a trader, right? So I'm careful that we can get ebbs and flows in this. We'll get rising inflation. It'll moderate for a little while, and then it can pick up again. I think that's the trick. And even going back to Zimbabwe, this is exactly what happened there. They had inflation go up to 10% at the beginning. then come back down to 7 or 6, and then go up to 30. So it kind of did these peaks and troughs, but it was always moving higher. And I think we're in one of those troughs right now. And the surprise in 2025 and going forward, I think, is that 3%, we're going to see 4% inflation before we're going to see 2%. And I think the Fed is, I was really surprised the Fed has cut rates this year. They've been wrong about everything. They were wrong. In the year before COVID, they put out papers in Jackson Hole about how this was going to be a continuation of deflation. They had to worry about the zero bound. I mean, I'm trying to be humble because I've been, we've all been in the markets and had terrible predictions and everything. But I mean, they were writing the huge study about how they were going to deal with, 0% inflation for the years to come, just as inflation is about to go to 10%. So just to say, they have not a great track record of seeing these things. So I think one of the surprises for this year is going to be that it's going to tick up again. Inflation will stay at 3%. They keep saying it's going to go down to 2%, but it's stayed at 3%. And one of the I wrote a post about this week, and one of the things is, let's start with a couple of things. One is positioning. All the asset managers are long bonds. Futures positioning is long treasuries in the 2s, 5s, and 10s to record levels, which I was surprised about. So you and I would just go, if there's record long futures positioning in treasuries, that's probably a contrarian indicator. The second thing is, just talking about the debt, that's one of the things you learn from Africa is when debt levels get out of control and debt is growing rapidly, it becomes inflationary. And that's one of the lessons we learned from the 70s. I think we got a period where it didn't happen, and I think that's thrown everybody, the whole post-GFC low inflation era and that's economics. You can go through periods where things, it's not a linear, but I think we have really stepped on the gas on debt creation. It's amazing that this Congressional Budget Office, which I think is often very optimistic about things, is saying we're going to have 6% deficits through 2035. That used to be 6% was like, oh my God, GFC, we have to stimulate the economy. 6% now is just standard. And I think that's a warning sign. Also, we grew the debt 40% in 3 years from 2019 to 2022. All those checks we got, all the business loans that were grants, that was a 44% step up in the total government debt in 3 years from 2019 to 2022. And my point is that was a huge jump, and it now shifted all the inflation and the interest rates higher. So we're no longer at 0%. Now we're in the 10 years in the 4%. So just as a balance sheet item, as a government thing, we're paying a higher amount on, we're paying 4% now instead of 3% on $26 trillion when it was 16. Anyways, the point, I know we kind of don't care about these things because almost like it's been the sky is falling forever and we kind of ignore it, but these are enormous numbers. And so it's a big setup to say that it's a big thing to say that this isn't going to matter. It's like saying gravity isn't going to matter. And the other thing is I talk about is inflation. And we can have all these debates, but people say, look, it doesn't matter. If inflation's 2 tomorrow, next year, 10-year yields are not going to go higher. And one of the one of my big points is about wage inflation. So a lot of people have been surprised about how resilient the job market has been, how low unemployment's been, and how high wage growth has been. So it's been still averaging, during COVID, there was all the stories about you couldn't find anybody, you couldn't find waiters and everything else, and wage growth was like 8 or 9%. But it's still 4 to 5. And I think this is my own personal view, and it's really hard to quantify it because it's so many people doing different things and in different situations, but I'm going to generalize. And you can tell me if you think it's kind of fits what you're seeing or not, maybe from the businesses that you're involved with. But I think over time, companies have been quick to fire people through after the GFC, during COVID, very quick to fire people and protect the bottom line. And I think over time, the American worker has started to build up defenses. I think they have been upskilling. When you look at the growth in college degrees, you see huge growth in engineering degrees, computer science, healthcare. Almost no one takes history degrees or English majors or French. So really much more hardcore science degrees, which are much more valuable. Two, I think people have really taken on board. It's like that book, Cash Flow Quadrant by Robert Kiyosaki. They're building multiple income families or situations. They'll do the job, but that's not all they do. And this is partly a cultural thing, but it's also technology and working from home. And it's all coming together that people are saying, fine, I will work the 9 to 5, but I'm also going to have a Substack. I might sell something on Amazon. I might have a second property and I Airbnb it. They have side hustles. They have multiple income streams in a way that when I was younger, it was like, oh, you just worked at a company and you tried your hardest and hopefully the boss liked you and you got a raise and a promotion. I think the mentality has shifted that they're not betting on the boss and the promotion in the way they used to. They're much more diversified. And so I think what the net result of this is, I think the American worker is in a way better spot to push for wage increases, be much pickier about the jobs they take, be much pickier about how much they're paid for it, and they're fighting for higher income. And the other thing is, I think they need to have it because what is underappreciated is during COVID, and you and Ben, you know Boise, you know Portland, I know Montana. I think the house prices, I say 30%, but I think in a lot of states it went up close to 40% if you go back to like 2019 to 2003, 2024. It was a lot of things. I mean, there was house prices went up across the country, but in the mountain states, you had this huge migration, a lot of people coming out of California, coming out from very expensive housing markets, wanting to get out of California my sister sees it in Montana, Arizona, Texas, and it's really, so what you've had is this big push up in house prices and with higher mortgage rates, right? So 30-year mortgage might've been 5.5 back in the low, and now it's 7. Again, it's like the debt. It's that double whammy of the higher balance because the house price is more and the interest rate is higher. And so I think people have been just slowly, you don't move up your wages 30% in a year, right? You have to, it's 5%, 5%, keep fighting, switch the job. I think we're still going through a gradual catch up from what happened with COVID in 2019, 2020. And so this is why I say, I think the man on the street or the woman on the street, cost of coffees, the burrito, the $15 salad, all this stuff, you go to the airport, the prices are insane. And people are going, I need to be paid more and I'm just going to try and get it. So sorry, the long answer, Ben, but I think we have much more entrenched inflation. And this is wage spiral inflation. This is where I get paid more, and then because I'm paid more, I can buy the coffee. And this is typical 1970s inflation. This is not like the oil price goes up one year. This kind of gets baked in and kind of goes round and round because, if I have more money to spend and we all have more money to spend, the prices of everything go up. And so we have to go back to the boss for another wage increase. So this gets very hard. This is what the Fed knows about in the economics papers. It gets very hard to get out of the system once everyone gets into this, called, inflation expectations. And I don't think people, actually what I'm saying about like wage, this strength in this bargaining power. I don't think people realize they have it. I think they're slowly finding it out that they just have to argue for these wages. But I think I don't think this is a theme that people realize yet. But I can see it in numbers. Why I can see the Atlanta Fed wage numbers are not, still bottomed out at 4%. They're not dropping, and the Fed's been kind of surprised about this. They go, wages are still growing a little faster than we expected. And so anyways, long answer, but I think that's you got the debt, we've got the wage inflation going on, and then the Fed, for some reason, I'm like, why are you cutting? You say your target is 2%, inflation is above 3%, and yet you're cutting. The job is not done. Why are you putting your foot back on the gas when the car isn't, when you're not at your target? And they have a view that, they're more afraid that they've overdone it and that we're quickly going to flip back into this, the deflation problem that we had before. So just like you and I, like I'm like, no, I do not think that is where we are. I think you're really jumping the gun here to be already talking about cutting rates and already doing it when you're not even where you promised yourself you're going to be. And so I'm like, when I was writing this in my post, I'm like, okay, fine, you have a difference of opinion. But I'm almost getting to the point, it's becoming too ridiculous, this cutting rates when typically, Ben, historically, the Fed's cutting rates when the market's crashing. The market's crashing, credit spreads are widening, the economy is going in a recession. Oh my God, what are we going to do? The Fed cuts rates and saves everything. This is like, we're at all-time highs. We just had Trump elected. Everyone's bulled up about, the economy is going to be great. We're going to get on the front foot. Bitcoin's at 100,000, gold's, everything is at all-time, great. Unemployment's 4%. Like, where's the problem? What are you doing cutting rates now? This is just gas on the fire. And it's almost making me say, I almost think you know what you're doing. I don't want to take a conspiracy thing, but I almost feel like you are trying to inflate us out of this. And this is really Project Zimbabwe. And you're almost not even believable anymore. You're talk about, that where you think inflation is going back to 2% and I'm like, really? I think this is actually, exactly what's going on here. So anyways, long answer, Ben. And so that's why I said, I think 2025 bonds are probably due for a move up to 6%.
Yeah, interesting. I think one of the things you're hitting on there too, that I think is interesting, the psychology that gets embedded with inflation is something that's hard to quantify. But if you go and talk to anyone about their grocery store runs or what's going on with rents or all these different things, it's not like 2%, 3% as far as cost of living increases. So I think that's part of why people are fine saying, hey, like, need the wage increases, need all this stuff to kind of keep pace there. But as far as the one of the things that I wish they kind of included in the CPI or a gauge of inflation was asset prices, because I think that would be an interesting way to like go back and kind of like look at the lens of the last 20 years and say, okay, like goods inflation might not be that high, but if you look at what asset prices have done from real estate to stocks to, you have bonds like trading below 1%, like that doesn't make a whole lot of sense for, anyone who's trying to get a real return, but that's where we went. And I think that that trend has started to shift, but we'll have to wait and see how it plays out. But as far as the bonds being the dumb money now, I think that's an interesting take. I'd be curious to hear you expand on that a little bit, because I know you've kind of mentioned that a couple times in some of your posts.
Yeah, this is more, I just think, for all the reasons we were saying, the 4.4% on a 10-year government bond looks ridiculous. But I went through this mathematical exercise, and we often talk about, we think of, it's a rule of thumb in the market that bonds are the smart money and equity is the stupid money. And what I was kind of doing was I was using a very simple asset valuation model that the price of an asset is the income stream of the asset over the cost of capital minus the growth rate. So this is called the Gordon growth model. So as you're, you want to discount it by the cost of capital, but also you want to take into consideration the growth rate of the earning stream. And just in behavioral psychology, this isn't, I mean, there's exceptions to this, right? You can get periods of euphoria, but just, this is my experience, is with a lot of things, people underestimate the power of long-term growth rates, like, and small differences in growth rates over a long time. So when you do these mathematical things, this growth rate adjustment in the cost of capital minus the growth rate is actually a very big deal. And I think what I was looking back over the last 10 years of the S&P is that we have had 7% compound growth in earnings per share in the S&P. And so if you put, I was like, okay, so if you, let's use 6%, right? So like, it was actually 7.7, but let's use 6, it's maybe a touch conservative. And people say, oh, well, it's a side argument, but often in economics, when economists do this, they like to use 3%. They think these numbers of 6 or 7 are too, they also use real GDP, which is a useless expression as well. But I was like, look, it's not 3%, it's 6. And these are nominal numbers. So they're not, people don't want to use high growth rates because, trees don't grow to the sky, but these are nominal numbers in paper dollars. It's basically, these are inflation numbers. They can be the growth rate. I've worked in places where inflation is over 20%. Yeah. I mean, when inflation is 20%, the prices of things go up at 20%. So just say, let's use 6. I backed into what would be the fair value, like what interest rate equates the fair value of the S&P today. If the growth rate is 6, continue to be 6. And that's where I said it came out at over 6% 10 years. And I was like thinking back to like what we kind of know intuitively is if you talk to guys investing in the S&P or the NASDAQ or even Warren Buffett, they're going to go, you want me to sell my S&P index fund to buy a US government bond at 4%? You're like, no effing way. I'm killing it in equities. They're growing, like they just know that the equities return more and 4% just to them does not feel attractive. But the math is saying it too. The math is saying you're not going to shift guys out of equities into bonds until 6%. It doesn't mean that those two asset classes can do their own thing, and it doesn't mean that bonds are going to go to 6 because of that. But it just meant actually the bonds seem really underpriced. And alternatively, if you have an asset class like an equity index, which is going to grow at 6%, and the risk-free rate is 4, yeah, the equity looks better, looks way better. And so that's why I was going around. I was like, you know what? The bonds look like the wrong price for all these reasons.
Yeah, I think the valuations on some of the stocks make me a little bit nervous, but I can understand why. Like, I'd rather own equities than bonds, especially the longer dated stuff. I think that's why you see a lot of smart guys in the 1 to 2 years and like shorter duration and stuff. But something that I find more attractive as far as valuations are some of the commodities and the equities in that sector. And this kind of goes into some of the Project Zimbabwe thesis, but I'd be curious to hear your thoughts on some of the commodities, if there's certain parts that you think are pretty interesting or anything that you've been focusing on in the commodity sector.
I'm in the energy stocks as well. I haven't done well. I own I'm too beaten up, but I like the big integrated oil companies where they've got a mix of businesses from downstream, refining, upstream, and they have great cash flows and pay dividends and buy back shares. So I kind of go with I take some of the sizzle out and I take the dialed down version of the energy trade. But I think the energy stocks, especially natural gas, looks interesting here. But I'm in the energy stocks, and I think gold is a bull market. I own more the ETF of the commodity rather than the actual miners, but the miners are they're starting to get the leverage that you play for. And I think people have been a little bit too critical about the this year. There were some disappointments, and the leverage didn't kick through as much as people thought. And my point with this on the gold miners is, and why I think it could be an opportunity, but I'm kind of probably like you, that, it's been so disappointing that you'd hate to go, I know everyone's gun shy on the miners, and I'm not doing it with my own money either, but I would take a point, because I know a friend of mine is the CEO of a gold mining company, and he made this interesting point. He said, look, when you've been running a gold mine for many years and the gold prices have been low, you have so many things that you need to patch up and repair and do when you finally get some money. So I think what's happening in 2024 and a little bit, but more this year, it was, machinery that had to get repaired, impairments, things that they wanted to impair but didn't want to do it when things were terrible, hedges that have rolled off, people that they've underpaid for years and just begged them to, hey, can you stay on? As soon as things are good, we'll give you that raise you need. And so I think a lot of these cost increases that people have been upset about this year, and I think there's a lot of built up stuff they've had to deal with. And I think next year will be next year, all the gold price, they haven't really earned, most of them, the average gold price in the third quarter was like 250 or 2,300. So they're not going to get the whole 2,600 until fourth quarter 2025. So anyways, I think the gold miners are could have an interesting 2025, where even though the gold price might not do anything, it might be this weird thing where gold does nothing next year, but actually the gold miners do really well. Yeah, so that's the gold, I think, is amazing bull market. And because I'm a big fan of crypto and Bitcoin, and gone totally down that rabbit hole. But the trader in me is a little bit cautious that as a gold investor, we had to sit through a 7-year bear market from 2013 to 2020. And all the gold bull story was correct, right? All the money, debt growth, fiat currencies, the whole thing. And I've listened to, the whole time, the whole 7 years, I just heard the story about gold and I agreed with it, but it still did nothing, right? And it was just markets do that. They will drive you insane. They will go through a period of you're in the Kalahari Desert and nothing's going on. But you're I don't understand it, because the whole story is true. And then it will just go for a ripper. Then, once it's done, it's consolidation. And I think now gold is in a multi-year bull market. It put in the hard times. It's done the consolidation, washed everybody out. If you look at ETF flows, it's amazing. October was okay, but for most of 2024, retail investors have been selling the gold ETF, which I love. And it is such a great sign. We have the start of a multi-year bull market, in my view, and then nobody believes it. Then retail guys are not buying it. They're selling the ETF. Oh, great. It's finally going up. Can I finally get rid of this thing and then go into Bitcoin, right? So this is all, to me, behavioral good signals. Whereas with Bitcoin, I go, oh goodness, the Bitcoin ETF is, I remember, I loved it when it was a stupid thing that everyone made fun of and it had no value and what a scam and all. Tell me those things. That's when I love it. When it's an ETF on the New York Stock Exchange and Larry Fink from BlackRock and everyone's loving it. I'm sorry, I get the opposite impression. I go, if billions and billions of dollars are flowing into the ETF, we might be at, it can bounce around, and Bitcoin has made a new all-time high, right? So part of me is wanting to say, I think crypto need to take a couple years off, and it will drive the crypto people insane, but welcome to the party. And because the gold guys have been through this, and you didn't need to learn, a crypto winter is not 18 months. It might be 5 years. So, but I say that but I'm on the other side. I'm also like in the Project Zimbabwe thing, where I'm like, maybe it does go up, but my sense is the setup is better in gold just because it's so much more washed out and hated. And I love that the central banks are in there buying in a way that they never did. I think the confiscation by the US, I think it was more the Europeans, the confiscation of the Russian US Treasury holdings after the Ukraine war. I'm not saying I'm not supportive of what Russia did, but as a reserve currency, like as the US, like running this global reserve currency that we want everyone to use and it's super useful, I think when you impound over $300 billion of a country's treasury holdings, you've just shocked everyone and you make it not a risk-free asset. And so I think this is when you now look at the World Gold Council and you see the buying, the Turkey, Philippines, Singapore, and they're all piling in. All these central banks are adding to their gold reserves. I think the lesson from 2022 was, like if you kind of get on the wrong side of the US or you do something they don't like, they might just take all your money away. So maybe maybe I should have some gold. So it's this nice backstop. You have like totally almost price insensitive central banks coming in, just buying billions and billions and billions of dollars. So anyways, that's why I think gold is one of those things where we're underestimating. I used to work for this guy that he would say two things. He would say people underestimate the size of the trend and the duration. So they often, like, basically they lack imagination. And I think the gold is like going to go much farther than we think. And so I think that's a big one.
Yeah, I think it's interesting to look at something like gold, and like you're talking about the miners, it's kind of in a business form, a long gold, short oil position. But the you look at some of those, and I haven't found anything where I'm like, okay, this makes a whole lot of sense. And I'm sure there are some explorers and whatnot that look pretty interesting. But when I look at like Bitcoin and some of the stuff you're saying there, like I think it's definitely closer to euphoria as far as sentiment than something like gold is. And you have people talking about MicroStrategy and Saylor inventing the magic money tree with the convertibles and all that stuff. It's interesting to watch. But
and one other thing on Bitcoin, I remember all the, I'm just trying to be realistic. Okay? So I remember back in 2013 and 14 when we were reading about it and hypothesizing about it, how we were going to possibly be buying coffees with Bitcoins and like we'd be using it for all this stuff. I have to think if you're a Bitcoin guy, you have to be fair and score yourself and go, the day-to-day adoption that we expected has been really disappointing in terms of where we thought we would be 10 years ago. So I'm not like, if I was to kind of make the bear case, I go, by the way, the store of value thing is fantastic and it totally has it. And it's amazing the network effects. You can trade Bitcoin everywhere. And people in Africa, when there's currency controls, like the businesses will pay for things from China using Bitcoin because the Bitcoin can transfer and all that stuff is great. But I just do go, let's kind of be realistic that we don't actually use it for anything like we thought we would. But anyway, sorry, I went on a side tirade.
It's good to look at those things and kind of see what's going on in different parts of the financial world, because you kind of have to be keeping an eye on it. But one of the things, just to go back to what you're saying about natural gas, like that's one of the places that I can't get all that excited on for the commodities and the energy space. But I'd be curious to hear why you're bullish on Natty going forward. So that's one I've kind of put in the too hard pile, at least for now. So
yeah, I wonder if it actually might be the best one. And I remember when the whole when shale gas and shale oil first kind of started going, which was 2006-ish, 5, 6. And, horizontal drilling, and oh my God, you can, frack things and get gas. But always the, the pushback was, you need to keep drilling. Like, these have fast decline rates, a lot of these wells. And that story, and so it was always, what's been surprising is the efficiency gains, right? The wells have gone deeper, multi-stage, they go longer, they frack better. Maybe the geology of figuring out where to drill has improved. All these things have been amazing. And the production in the U.S., in oil for the U.S. to go from like 5 or 6 million barrels a day to 12, nothing has ever happened like that in the history of any oil field. I don't know, maybe Saudi Arabia when they first discovered it, but it is shockingly positive. Okay, I say that I just lay the table that it's been amazing. But I think we've gone to sleep a little bit on the fact that the underlying of these basins, I think these wells still do have high decline rates. And the rig count on for natural gas, oil as well, but more so in natural gas, I think it peaked out like 2018 or something. It has been at almost record lows for 4 or 5 years. And you haven't seen, and natural gas production has still been kind of slightly growing. Partly because it's also coming out of the oil fields, right? So you're getting associated gas from the oil drilling. What is interesting this year is, for the first time, natural gas production has flatlined. And when you go into the field by field, what's happening, the Marcellus is starting to decline. I think Louisiana is starting to decline. The Permian in Texas is still growing. But overall, you're starting to see these fields, it's starting to get spotty. You're starting to see declines in some of the big ones like Pennsylvania, but you still have a little bit of growth in Texas. But overall, the picture is flat to very slightly declining. I'm like, oh, this is interesting. The rig count is totally in the toilet. But everyone kind of gave up caring that the rig count actually ever had any relationship to gas production, because of all these efficiency gains. We're like, oh, it doesn't matter. One rig can do the job of 5. And so, I've given up being bearish on gas production, and I've given up caring about the rig count, right? That's where we got. And I'm like, okay, that's fine. But it is really low, and it has been really low for years. It would make sense if this is going to finally start to catch up with oil and gas production. And lo and behold, we start to see this year the production is actually going slightly negative. And now you go, at the same time, we're having this AI boom, right? Oh my God. And I track venture capital and private equity deals quarterly in my blog, right? And I just look at, and I'm like, so many capital raises for new AI companies. Private equity, when you look at the private equity, you talk to private equity firms and you look at their website and they talk about their top deals and their themes, they'll always say they're into digital infrastructure. Like, that's the hot thing if you're a private equity fund. What does that mean? It means we're investing in data centers. No-name private equity funds you've never heard of will tell you how they're experts in data centers. I wish they would go down the road and talk to the other private equity firm in the office next door, because they're all doing the exact same thing. So anyways, the point is, I think we're going to have this, like, possibly this combination where natural gas, this wealth of gas we've had almost too much, finally inflects downwards, and the demand because of AI centers could be starting to grow. So that's, and it's so cheap, like $3 for natural gas. I think in Europe it's 14, and so anyways. And one other thing that is a little extra kicker. I don't remember the total count, but there are a few LNG projects that have been kind of on hold because I don't know why exactly Biden didn't like them, if it was environmental reasons or whatever. But there were projects that were meant to be completed, and their permits had to pause. These things will, like, I think it's the Rio Total Energies is involved in one of them. I think it's called the Rio Grande LNG project. There's, I think, of several of them. The point is, Trump will totally fast track this. It will be like, oh, done tomorrow. You want to build a multi-billion-dollar LNG facility? So what we're going to have is more draining of natural gas out of the U.S. For, and where they send it to the Asia or Europe. So I don't know. I kind of was like, I think but it's scary to actually buy the pure play natural gas stocks. So I'm kind of getting it in a chicken way, kind of a scaredy cat way through, Total and BP. So.
Yeah, I think it's interesting to look at nat gas, and like you said, the Permian's getting gassier. Some of the decline rate stuff is going to come into play here soon. And one of the things that is interesting for me to watch is people talking about the Permian and all the stuff with the oil production there. They kind of go into, oh, look, it's growing to all-time record production. And it's like, well, we're including NGLs and other stuff in that count now. And we're kind of looking at some of this stuff. Like I struggle to see how we're going to get 14 million barrels a day from the Permian, or in total production, with oil at $70. But I think it's interesting to kind of watch all that stuff. But it's basically been the overhang really is kind of everyone talking about OPEC spare capacity, this and that. And I mean, the inventory levels, all this other stuff doesn't seem to matter a whole lot. And I mean, obviously there's conflicts going on around the world. You can't really build a bull case on geopolitical uncertainty, but it's interesting to watch oil hanging out at 70 and like all this stuff going on, but you can't really seem to catch a bid. But I don't know if you have any thoughts on the long-term prices there, because it kind of feeds back into your inflation Project Zimbabwe argument that, like, if things really do start to head that direction, like, we're probably not sitting at $70 a barrel for oil and natural gas at like $3, give or take. So
yeah, one of the things, oil is a really tough one, and I used to be super bullish on oil, and I'm more mixed now. One thing is, I think, like you said, I don't think we're going to 14 million barrels in the US. And everyone's like, oh, Trump's super bullish on drill, baby, drill. I'm like, that's fine, but I don't think the oil companies want to, oil is not at a great price. I mean, it's okay price, but they're not waiting for Trump to tell them to drill more. So, sorry, I don't think Trump's presidency changes the oil production level in the US. I think it's already at a high level, and it's more about, finding good acreage and projects and prices. The other thing is on the conflicts. One of the things about Trump, one of the big bull cases on Trump, is that he's going to settle wars quickly, and because he's got much more credibility, and he will sort things out. I can see that happening with. First of all, I'm like, okay, that's a very consensus view, and that contrarian in me kind of wants to. I'm like, what if this is actually going to be what? That contrarian view, I always go, people are very certain that he's going to. Okay. I just note that is very optimistic about all the wars in the world are going to get sorted out. We may be surprised that the whole thing is more complicated than we expect. But anyways, I could see the Ukraine-Russia thing getting sorted at the status quo. It's some version of, you guys we're calling it a timeout. Like, the line is where it is now, and the war's over. The Middle East, I think, is harder to cool down, because I think we've crossed a Rubicon for Israel and Iran, and we'll see. I mean, I'm so far that everyone's been working really hard to dial that down, but one thing I look at, I go, look at the Red Sea, okay? Who would have thought a year ago that the Suez Canal was basically untraversable? The entire Red Sea, one of the most important transit points of the entire world, you have the Panama Canal, the Suez Canal, most important way for ships to go from India, Asia, anything up into Europe. It's a huge freaking thing. And you can't even go there now. And I'm like, wow, like we kind of forget, like, okay, a major waterway has turned into like a pirate zone of missile strikes. And I'm like, what if the Persian Gulf turns into that? What if 6 months from now, and let's not forget, Trump was the guy who did a drone strike on Soleimani, which was the Iranian general who decided to visit Baghdad for some reason, and they knew about it, and he's in his convoy, and they blew him up so badly. The only thing that was recognizable was his finger lying on he had this ring, this famous ring. I don't know if you remember this, Ben, but he wore this big bobbly ring, and his finger was blown off his hand and lying on the pavement, and that was how they knew it was him. Like, that was a super confrontational move. So I'm like, Trump is... Anyways, but I'm like, okay, on the oil side, if something there could be a case, and I have a big imagination where, what if the whole Persian Gulf kind of turns into the Red Sea, and there's missile strikes, and it's dangerous. It's hard to get oil out of there. Saudi's trying to build a pipeline to get it out some other way. What if we lose 6, 7, 8 million barrels of production out of a war zone? And nobody is thinking about that. I used to play ice hockey. So I know I'm jumping around a lot, but I played ice hockey in high school. And there's a thing called the bench clearing brawl, right? You know, right?
And that's the best part of watching hockey.
Best part of hockey, and it's why all my friends they didn't really care about hockey other than hoping that there would be fights or something. But there's kind of like fights are kind of controllable for there's a tipping point where they kind of go from they're controllable to then the whole both sides of the bench is clear off and the thing goes nuts. For now, things have cooled down there, but we've definitely that's just an interesting case for energy on the bull side. On the bear side, what I don't like is when I look at the sovereign wealth funds, when I look at the private equity funds, when I go through their annual reports, I like to go through the annual reports of the big endowments and the pension funds, and I look at what they're doing, right? And there's been a huge shift in allocation to private equity. And when you look at the annual reports and when you look at the private equity funds, it's all about wind farms, solar, energy transition. And I'm not saying I want to own the wind farms and so on, but what I look at it is I go, there's been a huge investment into energy as an asset class. It's not oil, right? It's a different type of energy. It's solar and it's wind. But I'm like, at the end of the day, there's too much, like when you want to be contrarian, right? Like we look at the CapEx of the energy companies, we go, oh, they're not investing. No one's buying rigs. No one's, investing in new oil fields, and that's bullish, right? But then I go, and this is what kind of, I was like, what the bearish side is, yes, they're not investing in oil, but there's a ton of electricity coming in. And then you go, okay, but that's electricity and that's not useful for, planes or ships or, cars and trucks. But then you have this kind of creeping shift into EVs in the fleet, right? And it's still minor. And so that kind of story just bugs me or makes me cautious. But on the positive side, the number of people in the world, like if emerging markets, when you look at the billions of people in India, Indonesia is like 200 or 300 million people. Africa is 1 billion people. And there are so many places in the world that are not suburbia and can run on electric cars, okay? That where power is intermittent, it doesn't exist. They don't have a charger outside your house or a, solar panel and you're attached to your roof. Like there's lots of places. So and there's another backstory is emerging market demand could still surprise on the upside, and still like cause a bull market in oil. But we don't really think about it because everyone's bearish on emerging markets. But anyways, sorry to go all through the things, but I'm more I don't know on oil. There's a mix of positive and negative.
There's definitely, as far as any of the commodity markets, there's probably more moving pieces with oil than just about anything else. So it's hard to kind of sift through all that and make a make a decision one way or another. But it's interesting to see all the stuff that I've seen coming out of the Permian. I think next year is going to be an interesting year to watch. We'll see what happens, if some of the narratives you see out there are going to come true or not. But as far as you mentioned Trump there and the drill baby drill mentality, I think that'd be a good transition into your thoughts on like Trump 2.0, his second term, what tariffs might look like, any other potential impacts from his inauguration here in the next 6 weeks, 7 weeks. But what do you think that looks like for financial markets when Trump gets in?
Okay, on the tariffs, a lot of the things I think he's going to deal with, like I'm not sure immigration has a big effect on that topic is going to have. It will cause a lot of news, but I'm not sure it's going to be a big thing for financial markets. On the tariffs, I think, of course, let's appreciate that when we say 60%, it's a little bit of a negotiating tactic, right? So you start off the ridiculous number and maybe it's 25, right? Or just to say that as one thing. So my first thing is to temper down whatever the number is and cut it in half. But still, my reaction is this. I follow China a lot, and they are amazing. And I cover emerging markets, right? So I've looked at emerging markets for a long time, and I've seen lots of emerging markets and how they develop and where they get to and where they don't and whether they disappoint or everything, right? China is amazing that they have gone from low-end manufacturing, like in my memory, to cars that they come back from China and they go, these things are next level. It's now happening in chips. They're, moving rapidly up the chip sector. Anything they are mastering as fast as they can. And and we're seeing this now, right? It's 2024. What we forget was back in 2015, this is a longer term strategy, but there was a notable thing in 2015 where they said, made in China 2025. They made this big long thing that they were going to master, they were going to dominate a series of high-tech industries by 2025. And here we are in 2024, and the car companies are freaking out, and the semi-investors are starting to notice that this could be, semis could be the new, or could be the next car industry, where China comes in and slashes prices and creates all this new competition. But I'm like, that took 10 years of steady, methodical effort with planning and consistency. And I'm like, what's my thing to Trump? I'm like, or all of us as Americans, I'm like, look, yes, we want to have more manufacturing and we want to do all this and onshore things and make more in the US and high-end manufacturing, et cetera, et cetera, et cetera. Let's be like the Chinese. Let's have a 10-year plan where we know what industries we want to, which ones are going to be the important ones. Where are we going to be consistent about it? Let's take the long-term view. Is there technology we need to know? Are there schools and degrees or anything, whatever? What does it take to get there? I don't like this slapdash solution of we're just going to tariff everything. I think it looks weak. And that's why I'm like, this looks like something they would do in Africa. They always do this thing in Africa. They call it, and they should do it in South America too. They call it import substitution. This is, we hate that we're importing all this stuff. So let's put up taxes or let's put up currency controls. Let's make it impossible for the foreign things to come into our country, and that will develop the local industry. what usually happens is it creates a ton of protectionism for a couple guys that do this product, usually not very well. The incumbent guy who makes whatever, makes washing machines or something, takes a ton of market share because no one can import, and they become billionaires usually. But that doesn't turn into the Asian, the Thailand, sorry, Singapore, South Korea, Japan, China. They won by being export focused. So I look at the tariff thing and I go, this is a really short-term fix. It's not strategic. And what's going to happen is it's going to be inflationary. Because they're going to start, you already hear him talking about, oh, the Chinese have started to react to this whole thing and move their factories to Mexico, right? I thought this was very interesting because I had a friend who owns a flooring company. He's Canadian, right? But he imports all his flooring material from China. I was like, oh, he's already been switching to other places like India. But he says, what? I was like, oh, but isn't it sticky? Like you can't, like those factories in the supply chain, everyone's in China. That like, how do they change? He goes, oh, the entire group of them up and move to Mexico as the whole ecosystem up and moves to Mexico and creates a compound where they all work together. And so now you see Trump saying, well, we're going to shut down, we're going to tariff Mexico. The other reasons because of the drug dealing, but also that they've noticed that a lot of Chinese exports go to Mexico, they do add a little thing, screw a thing on here, do some small value add, and it goes into the US. It's like a backdoor, right? So now we have to tariff China. Now we got to tariff Mexico. We got to tariff whoever else where this can happen, right? By the end, you're tariffing.
You get a tariff, and you get a tariff, and
the
you get
whole
a
world. We're going to tariff everyone everywhere because it's like whack-a-mole. Like, and you're like, okay, so that is probably not in the next 1 to 2 or 3 years going to create a bunch of new factories in the US. And yet we're going to put probably 15 to 25% price increase on everything that we're coming in, which is a lot. We have record trade deficit right now, okay, like all-time high. So we importing things more than ever. And like you and I are just going to have 25% government tax. You're like, okay, well, that is a tax. Where is that money going? Do I get that back? I mean, I don't know, Trump, where does the 60, 80 billion go? And I'm supportive of it. I'm not saying that's a negative thing. I just go, okay, cool. So you're going to raise a lot of money. Do I get it back somewhere? Because when I go to buy like the TV from Samsung or whatever, it's going to be like 25% more. That's going to suck. Where do I get it back? Oh, well, there's $2 trillion deficits every year. I'm sure the money isn't going to come back. We're never going to see the money. In economics, this would be called a deadweight loss. We're all going to lose from this. You're probably going to have to buy less goods because they're all 25% more expensive. Demand shifts down because it's the same thing. It just costs 25% more. And I think the end, like we going to the beginning of this conversation, me, you, your friends, everyone, we're going, oh, stuff costs more. And the guy at the store goes, yeah, but like there's all these tariffs. And they won't hit right away because I think right now you're probably seeing a lot of people in stocking inventory saying, ooh, we probably got 4 or 5 months to get stuff. Let's get a year's worth of stuff in here and we'll deal with it whenever it gets sorted out. But the end result is, I think this is going to be inflationary. It adds to our view that we had at the beginning of this call that inflation is here. The other thing about inflation, which people don't, like economists don't deal with, they look at the oil price or they look at the this and that. When you go into Africa and you look at when things are really inflationary, it's regulatory, it's bureaucracy, it comes from rules, regulations, tariffs, currency controls, that kind of stuff where the economy just doesn't function very well. And when the economy functions well and whenever there's a price, when entrepreneurs can jump in and drive prices down and grab opportunities, prices are low, the inflation's low. When you start putting all this grit and protectionism in the system, that's when you get inflation. And so that's my long answer to Ben that's my biggest takeaway from Trump is I know what you're doing and I know why you want to do it and it's fine, but do the back end work. have the 10-year plan, have the strategic industries and what you need to do there, because I think you're doing all the front end bluster without, and we're going to get the negative effect and not the benefit. I don't think this is going to turn into factories coming to the US.
Okay.
Or very, very little. Sorry.
No, that was one of the things that I was kind of thinking about is maybe a potential pushback is like, do you think that if we do get like significant reshoring, like I think one of the things you said, the like Singapore and the other Asian economies are winners because they were export focused. And I think that's because like a lot of those industries need access to the US as like the end market for those products. But if you do have like a reshoring, just to kind of play devil's advocate, I guess, like, do you think that that's something that could maybe change your view if it does turn out to be a little more successful on the reshoring side?
Reshoring. Okay. First of all, on the low end stuff, I don't think that works.
Yeah, but the
on
wages are too
cost side,
high to
right?
be making like the cheap trinkets and baubles here.
Yeah,
So
right. So, but that's part, like, that's not the whole story, right? But let's say that's a swath of things that won't be reshored. But then I think some things, like, and I struggled with this article, but there was a really interesting article about the TSMC factory in Phoenix. This was part of the CHIP Act that they were encouraged all these semiconductor factories, and Intel's doing them, and Micron, but a TSMC, which is the highest, the top of the top for semiconductor manufacturing. I mean, this is their thing, that they do the chips and designs. They don't do the design, but they do the manufacturing that nobody can do, like the Blackwell chip for NVIDIA. They tried to do a factory in Phoenix, and it just didn't work. The employees thought that they were too militaristic. They didn't thought they were being worked too hard. They didn't like all the processes. They didn't like all the presentations they had to give for I mean, they hated it. And they thought, and I'm like, I think there is, I think it's tricky. I think it's hard to I think what we're finding, and it was surprising, right, until you see it, but I think for some reason, these super high-end factories in Taiwan and South Korea are not transitioning well into the US. There's a great documentary about this on Netflix. It's about a car parts company. I think it's called American Factory or something, but it's about a Chinese entrepreneur who buys a car parts factory in Detroit, and he's so frustrated with the workers, and he takes them to China on a trip, trying to get them to learn the culture of the Chinese workers, who all wear these uniforms and stand in the roll call in the morning, and they try to do roll call back in the Detroit factory, and everyone thinks it's stupid. And anyways, I don't think there's going to be much reshoring. And the other point I want to on the reshoring, part of what China does so well is this network effect. And they build industrial hubs like Guangzhou and Shenzhen, and that's kind of the same place, but where the factories are there, the port, the logistics, train lines in. It's a network. It's not like you could just open one of these factories in Boise, or the chip plant is right next to the wafer company. I mean, so it makes it. That's like what my friend was saying. They were moving whole pods of them to Mexico because they kind of work as a group. So anyways, long answer, but I think it's doable, but I just don't think the tariffs are going to do it. I think if you're going to have to really say the industries you want and get into the weeds. Are there 5 different companies we need to reshore? That the one factory by itself doesn't work. You actually need the 4 other guys to also be in the same town or in the same state, and get into the weeds on how do you actually make manufacturing work in these high-end industries, because it might be more than just one factory. A lot of these things in economics, you need kind of little ecosystems. Phoenix might be kind of developing that in chips, but anyways, long story short, I think we're not going to see any effect of this reshoring for years.
Yeah, so it might be might be
2027,
tough.
maybe.
Yeah, might be tough to make manufacturing great again, I guess, is the short version. But I guess with some of the stuff you're saying there about China and some of the stuff that they do, I think it'd be interesting because you were talking before we started recording about your contrarian views on the Chinese, some of the stocks in the Chinese market, some of the European banks, and I wanted to get your brief thoughts on those before we start to wrap up. But I think those are two things that I find interesting. Haven't made any investments there recently, but I think if you're looking for some of this contrarian, there's definitely stuff in there that looks cheap. So I'd be curious to get your thoughts on those.
Yes. So yes, this is the contrarian corner, right? So
Yep.
let's be contrarian. Since we just talked about China, let's go there. First of all, in my Substack, every month I run a global screen of 3,000 stocks across the world. US is included, right? And I rank the companies on valuation, earnings momentum, whether they're beating numbers, so it's not just cheap, but the estimates are going up, and price momentum. So a little bit, that's the least important score, but this is the stock kind of going up. And this year, currently, it flips the US, and now the one thing with the factors, it depends. There's a lot of stocks from the US, so it kind of skews the thing that just so much the database is US stocks. But China is the best performing, best ranked country in the entire world right now. And this is because you have so many stocks there on 5 times earnings. The model likes that the PE is 5, earnings are starting to work now, and the prices are starting to, after that rally in September, the price momentum actually scores better. So just statistically, China looks great. You know, most stocks in the US are 15 times or whatever, market multiple is 25. The market multiple in China is like 5 to 8. Okay, so that's insane. It's the second biggest economy in the world, and yet, just as just a side point, right? Statistics cheap and fine. Just as a positioning thing, second largest economy in the world, nobody owns it. It's not in the MSCI World Index. It's in the EM Index, but no one really owns EM. Like, no, but I just amazed. Like portfolio managers, you know, I have fund managers in London, New York. No, like maybe Appaloosa Management owns it. Like, but odd hedge fund might own it, but in general, it is the second largest economy in the world that nobody owns, which I think is an interesting thing. Third, I think they're turning into a beast. I go, we're totally naysaying them. And by the way, here's another anecdote. My daughter goes to a school in London. It's called Imperial. It's the MIT. It's their UK version of MIT. When we moved into her floor, 70% of the kids on her floor are computer science engineers from China. They are, and you see it, this mastering of the semiconductors, this mastering of the EVs. I think China is really like gone from emerging market to like advanced and above and better than us. Yet like that's mixed, but in many, many things, they are on the verge or going to be above, operating at a higher level. It's kind of happening with cars. And I go, wow, this is like possibly the most advanced technical market in the world. Like we all love tech, right? This is the most technical market in the world. It's the number 2 largest economy. It trades at 5 times earnings. Everybody hates it. And all the other thing, on the stimulus stuff, right? Because everyone goes, oh, they're in this intractable thing. They're in a death spiral. They can't get out of it. They're not stimulating enough. I think they're just very sensible, right? I think if I was she, I would like, yes, it's not smart to do what we did with COVID. And whenever the economy has a little bit of a wobble, you juice the thing with multi-trillion-dollar things and grow the debt by 40%. And it's not a smart, like, yes, you do it to get elected and you do it because the people want it and it feels good at the time. But it's not, the Chinese are playing the long game and so there is stimulus coming, but I think people have just been upset that it hasn't been bazooka style. And I'm like, as a trader, I would love bazooka style. It'd be way, way more fun and we'd make money faster. But I understand as a reasonable autocrat running a country that you don't need to do it like that if you don't care about it. Like, so I actually just, my point on the Chinese stimulus is I think they're being methodical about it. You know, they're kind of just feeling their way. If they need to do more stimulus, they are. And I think 2025 is going to be great. So I'm, you know, I'm proud American, and but I just go, it's like, you know, you see the kid and you see this kid, or, you know, your peer, I just respect what they're doing. I think and I'm like, wow. And I'm actually slightly fearful of it. I'm like, I think they're really getting pretty good. I think our saving grace for the US is like a little bit like Japan in the 80s. They're not great at services, right? So they're not dominating global financial services. They're not dominating global tourism or media and or consulting, all these kind of skills where it's much more about communication and language. A little bit Japanese was the same way. They're never really great at English, so they really dominated manufacturing and making things. But there's large swaths of the economy and other industries where they don't do as well. So that's the reason. That's China. And I know that's not a favorite thing of anybody. The other one is European banks. And this is because I used to be a banks analyst. And banks were hated forever. They had multiple problems. They were undercapitalized after the GFC. There was an entire regulatory change, and like, oh my God, banks have to have these much higher capital ratios. We had 0% interest rates for a long time, and we had no growth. So banks were not lending because they were basically trying to raise their capital levels because of the higher regulatory ratios, capital ratios. When I started looking at banks, the tier 1 ratio, which is how much capital, it's a ratio of how much capital banks supposed to have. It was 6% was considered pretty good. The regulatory minimum was 4, right? But you're supposed to have a little bit more, kind of the bare minimum. So you had to have 6, and that was a nice number. After the GFC, that went to a tier 1 ratio of 9 right away. Then there was Basel II and Basel III. Basically, 12 years later, banks in Europe have tier 1 ratios of 13-14% when they used to have 6. This has been, and it's taken years for them to build this capital up. So 2 things have happened. They have more capital than they know what to do with. That whole issue is over. In fact, they have too much. Second issue was the 0% interest rates. And now we're in this, I think you think, higher, definitely interest rates are not 0. Remember, they used to be negative in Germany, right? Those negative 50 basis points. Now it's like 3. So a bank can actually just buy a government bond in Germany or France and actually make money. And plus, if you want to do corporate lending, there's a spread on top of that. So big step up in the margins and return on equity and profitability of banks. I think there's a third thing coming, which is going to be growth. And I'm like, because the banks, this is why I go back to the gold miners. Because I've been living through what the banks in Europe have been. I see the CEOs going through this like mental adjustment from, oh my God, we're making money. But they were still cautious. And now we're in year 2 of it. And like, oh, I think we can return some money to you. We're confident we're making enough. First year, they wouldn't return any money because they're like, we don't know, this could end. There could be a recession tomorrow. We don't want to be blah, blah, blah. Year 2, they're like, oh, wow. Now year 3, I think we're going to start to like, oh, this is sustainable, but just buying back shares and paying dividends isn't enough. I think we need to grow and maybe lend. And I'm like, actually, this could be a positive for Europe. So banks are great. All these structural tailwinds, no one talks about it. No one talks about European banks. They trade at like 5 times, 6 times earnings. They're paying out 30 to 40% of those earnings is share buybacks or dividends. So you're getting all this money back in free cash flow. The stocks haven't re-rated. I love them. I have like half my portfolio is these things. Like I have Santander, UniCredit, Barclays Bank. I even own a crappy one in Germany called Commerce Bank. So I think this is the greatest theme. Banks in the US trade at like 10, 11 times. No one talks about the European banks, and I love them.
Interesting. Yeah. I know some people are pretty bearish on the European economy. There's some different things going on there, but I think that's a pretty compelling case for the banks specifically. But before I let you go, I got to ask my traditional closing question, which
Oh
is
no.
which book should I add to my reading list? Can be history, finance, anything you think I would find interesting. So,
Have you read the Nassim Taleb stuff, Black Swan?
I think I've got the Spark Notes version, but I haven't read the full book. So
That's I would definitely read all the Nassim Taleb stuff. And really appreciating, and you being in the markets, you would, but I think really the financial markets are different in a way that basically one of the Sim Taleb's, kind of themes is extremistan, that we live in a world where things can be normal, and then a 5 standard deviation event can happen like in the next 30 seconds, right? Something a lot of businesses don't have. I mean, financial markets are very unique in that way. So anyways, I would say Nassim Taleb does the really good job of talking about these issues and talking like a trader, and also the concept of skin in the game. When you're talking to someone, when you're listening to viewpoints, being very attentive to who actually is on the line about these views. Is this just an economist, a professor just spouting views and theories, and they actually have no ramifications whether they're correct or not? Like they don't, like whether they're right or wrong, they have tenure and nothing, it doesn't matters not one iota whether they are actually accurate. Or a trader who's like, actually I have a $2 billion position in this thing. I really think this. And I'm totally, my entire financial career, my family, I'm going to lose my house if I'm wrong. Like, that's a guy like, oh, that's interesting.
Yeah, he has some skin in the game.
Yeah, I'm like, what? That your view? Like, there's something behind there. I'd love to hear what you think. So, anyways, there's lots of good stuff in Nassim Taleb. Anti-Fragile is one of his books, and then the Black Swan one. But I'm sometimes surprised when people haven't read them. I'm like, oh. And another one. I know this sounds dorky or whatever, but I am finding over time, like the truisms of Warren Buffett about investing and stuff, like they're like fine wine. I'm like, oh my God, I wish I had been more following that, over time. Like stuff like I'm finding a lot of things with a lot of stocks and stuff. I'm like, I don't really care as much about what business it is, what industry, what it does, what the strategy. It's the guys running it. It's like if you have really good managers, it maybe matters less what industry they're in or there's so many bad CEOs out there that can ruin potentially good businesses or be in sectors that are supposed to be great, but they're terrible. So I'm like, one of the Buffett things is to really focus on the people. And I think it's a harder one as an analyst to actually, it's hard to kind of get a feel for a CEO, right? Unless they're on the conference calls and you have to listen to, it's a harder thing to get a grasp of. But anyways, so just to say the Buffett letters and stuff, just I don't know. I know it's boring to read them, but I do think with time, I'm like, God, those are so good.
Yeah.
So right on the money.
I'll have to check all those out. I think my reading list gets longer and longer, and I have to find time to catch up. But I really appreciate you taking the time to come on.
Yeah, Ben, good talking to you.
The readers and listeners will find it interesting. So I think with that, we'll be wrapping up. Thanks for stopping by.
I know
we'll
we've talked a long time.